The problem with Toast is that right now it's priced for total perfection, which is nuts given its losses for the last 6 months. Toast's operating in a pretty competitive market where it's easy to change vendors. Beyond the big operators like Square, Lightspeed, now it's starting to get good. You've got a bunch of other players. There's Fiserv's Clover business. We had them on. NCR, remember the old National Cash Register? How about upstarts like Touch Bistro, Upserve, Harbor Touch, Revel Systems? You get it? It is crowded. You can play these guys off against each other. I know that from personal experience, which is bad news for Toast pricing power or lack thereof. They just timed this market right. Let me put this one more way. When Toast did a private fundraise in February of last year, immediately before the pandemic, the company was valued at just under $5 billion. When today's IPO priced at $40, it was valued at $20 billion. When the stock opened at 65 and change, it was valued at $32 billion. That is lunacy. Sure, Toast should be worth more than it was pre-pandemic, but is it really worth 6 times more? Even if you assume the company can keep growing at a 105% clip, that would translate to $1.69 billion in sales this year. That would mean Toast is trading at 19 times sales, which is perfect if everything went right, and that's extraordinarily expensive. Plus, I don't think the company can keep growing at a 105% clip. Remember, they were up against some very easy comparisons the first half of the year. If Toast growth slows to, say, 75% in the second half, still something that many companies would kill for, that gives you a $1.54 billion in sales. Given where the stock's currently sitting, the valuation works out to 20 times sales. That's what Wall Street's willing to pay for the fastest-growing cloud stocks. Problem is, Toast is mostly not a cloud business. There's a lot of hardware in there. By comparison, Square and Partech both trade at roughly 6 times. Lightspeed's more expensive, trading at 33 times, but it's growing faster than Toast. The analysts are looking for 137% growth this year. Honestly, I think Lightspeed's too expensive, too. Finally, one last concern. This IPO today was what's called a sliver deal. Toast has roughly 500 million shares. Today, they sold just 25 million, only 5% of the share count. A major reason for the stock spike. They've got a tiered lockup expiration, but within 6 months, I expect this one to get hammered once the insiders can ring the register. Here's the bottom line. I like Toast the company, but don't chase Toast the stock. There's too much risk, too much competition, too much not enough earnings. And most of all, take it from me, they're dealing with the worst set of clients in the world, struggling restaurateurs.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.